We start strong here after this historic press conference with William Dudley. He's a former New York Fed president, a student at California, Berkeley years ago of our monetary history, and of course, Bloomberg economics senior advisor. As I said, Bill, I got goosebumps. It just seems to be a massive statement that even if we have nominal GDP of 4%, we have immaculate productivity and will somehow get through this. Do we sustain this market reaction, this belief in America, or are we set for some titanic disappointment?
Well, I think that Powell's press conference made it clear that he's really pleased by how the economy's performed. The fact that you could get inflation down without the unemployment rate going up, he had some moderation in wages. He thinks everything is going really, really well. And I think that's true. The question is whether it's going to continue or not. And there are definitely things that can go wrong. One thing that can go wrong is the Fed keeps monetary policy too tight for too long and we have a weaker economy. Another thing that can go wrong is the Fed can ease policy prematurely, or the market itself can ease financial conditions prematurely, which will stimulate the economy and make it so that the Fed can't cut rates at all as quickly as the market expects. I think the market's getting a little ahead of itself here in the sense of taking the Fed's optimism and translating that into very large reductions in short-term rates in 2024.
Bill, what do you think happened to the Chairman Powell of only 2 weeks ago?
I just think that they're very happy with how the economy's performed. I mean, basically, they've had decent growth, unemployment rate's stable, and inflation's come down a lot. And that's basically, as good as it can get. And that's really what's summarized in the summary of economic projections. Now, summary of economic projections shows a very modest increase in the unemployment rate from here and essentially a soft landing kind of forecast. Now, soft landings are really difficult to pull off, and they're particularly difficult to pull off when you've been very late to tighten monetary policy. And what's allowed this to happen is that there were supply disruptions, there was a reduction in labor supply. Both those things have reversed, and that's made the Fed's job a lot easier.
Bill, the prospect of getting sticky inflation into next year, getting stuck at 3. It's amazing because 6 months ago, Bill, we were told that the last mile was difficult. It was hard. Then Secretary Yellen starts sounding like the Fed chair again, saying it's not that hard. You hear it from Chairman Powell, didn't get any indication it would be particularly difficult into next year. Do you think that is the prudent approach to what 2024 could look like?
I think he's telling you what he really thinks. I think he's very happy with how things have performed. And he didn't say it would necessarily continue, but he also said that he was hopeful that these trends would continue into 2024. My own view is that the Fed is going to be cutting rates in 2024. We're clearly done in terms of rate hikes. The possibility of another rate hike is really low at this point. The question is really just timing of rate cuts and magnitude, and that's going to basically be driven by the strength of the economy, pressure on resources, and what actually happens to services inflation at this point.
Bill, do you think that Jay Powell did a good job? Do you think that it was right for him to say what he thinks and not push back at all against the market party?
I always think it's good to say what you really think, but I think the problem with doing so is it's basically added fuel to the fire. Powell talks about the long legs of monetary policy, but financial conditions are much, much more accommodative than they were just a few months ago. And if you look at the Fed's own assessment of financial conditions back at the end of October, the impulse from financial conditions to the economy based on the Fed's own model was pretty neutral. So financial conditions now are actually adding impulse towards economic growth going forward.
I look, Bill, at where we are, and it's clearly beyond the pandemic. We've had a number of conversations all across a long surveillance day about how goods are goods, and we've got some deflation and service sector inflation's coming down. Is this economy beyond the pandemic? If you were to talk to Mary Daly in San Francisco, to John Williams at the New York Fed, can we say our economy is beyond the pandemic?
I think mostly in the sense that the conditions today are very similar to where we were in February 2020 when we had a very tight labor market. The difference is wages are a bit higher, inflation's a bit higher, and monetary policy is considerably tighter. But it does feel more like February 2020 than it does between any period after that.
Bill, sit tight. I want to bring in Mike McKee down in Washington, D.C. Michael McKee, you were in that news conference. Were you surprised by the approach from Chairman Powell?
Well, I wasn't surprised by the approach once we'd heard from the Fed and in their statement and what we saw in the dot plot. But it is a rather dramatic change from what he said just 12 days ago about it not being time to talk about rate cuts. Obviously, they did today. They're feeling much better about the overall state of the economy. As one analyst put it today, if a good inflation report is Jay Powell's idea of a good time, then his party has turned into a rager because inflation is coming down very quickly. And then the next question becomes, as I asked him, when do you cut? And that's the part they're not ready to get into yet or describe. And so we're probably still in for a few months of the markets watching the data and trying to guess when the Fed is going to respond.
Michael, within all the blur of the data and all the guesstimates forward, did they frame out a subpar GDP, either real or nominal? Did they frame out subpar growth?
Well, basically, that's what Powell said we're going to get because the direction of the economy is slower and the lagged effects of their rate increases have not yet completely been felt. But that the economy will start picking up again and growing to potential. And he also admitted the possibility of a surprise there, the economy grows faster than expected, is also very real. So I think they're, at this point, working on the models that they have, but admitting that they have been wrong before and we could see faster growth. But the interesting thing was, other than a sort of perfunctory caution, he wasn't suggesting that we are now, that they would go back necessarily to rate increases.
Mike McKee, thank you, sir. Great job today, as always. The reaction pouring in this afternoon, this line from Steve Cheverone over at Federated. Initial take is he wants to cut. He always saw inflation as transitory. Bramo, your favourite. It's come down on the supply side. He smells a soft landing and wants to cut to stick the landing. He had no interest in pushing back against market expectations. Right or wrong, it's bullish for now. That's a takeaway from Cheverone this afternoon.
That's exactly where I wanted to go, and I wanted to get Bill Dudley's opinion about whether we did get basically confirmation of transitory. Do you think when we look back, the Fed won't have been wrong when it came to transitory inflation? They just were premature.
I think that most of the inflation pressure we had was transitory, but not all of it. I mean, I think some of the services inflation is due to the tightness of the labor market. I think what's really interesting about Powell's press conference today is he talked also about the risk of being too late to cut. So he actually admitted the possibility that if we stay tight for too long, we could actually have an economy that's too weak relative to what we desire. And that's something new from Chair Powell.
That's a very important point, the ex-postedness of it, if you will, Dr. Dudley. They've got to wait after the fact. So let's take something coarse like the unemployment rate. How many months do they have to wait until they get real confidence that the labor economy is caught up with our immaculate disinflation?
I think they're going to be looking at what happens to the unemployment rate, the tightness of the labor market, and what the consequences of that are for wages. Powell did admit that wage inflation is still a little bit too high to be consistent with 2% inflation. But boy, the Fed is pretty close to where they want to be in their outlook at this point.
Bill, you've been on the committee before. You can look at this from the outside now. It's a tricky game, this one, to get into someone's head, and I think maybe one we shouldn't play, but I think on this occasion we should. 2 weeks ago, I heard from a very different Fed chairman, and I'm trying to work out what happened today, whether that was just a man who was representing his own views and this was a man who was representing the committee's view, or whether, like we've indicated, he's being seduced by this idea of netting a soft landing, and the guy who was trying to act like Volcker was never really Volcker. What is it? What do you make of who Chairman Powell is and what he ultimately thinks about things?
Well, the fact that he's worried about keeping monetary policy too tight for too long tells you that he's not thinking like Paul Volcker. So there is there is a risk to the Fed cutting rates prematurely. But I think what's coming across is the fact that he's just really, really happy with how things have evolved, and that optimism is showing through, as it has shown through from time to time in past press conferences.
Right. Bill, it's maybe not your remit, but it's certainly the New York Fed's remit. They're going to keep track of flows off of declining interest rates. What is the stability or instability that you observe in $6 trillion of cash, let's say most of it loaded in money market funds? As that yield comes down, is our system going to be able to handle it?
Yeah, I don't think there's going to be any problem. I mean, the Federal Reserve sets the short-term interest rates, and then money market rates trade off that. If money market rates, firm up a little bit, then money will flow back into the money market mutual funds. I'm not worried about that at all at this point.
Bill, just to wrap it all together, do you think that the chance of a hard landing has gone down materially over the past month, or do you think that it's about the same or even has gone up?
Well, I think it's gone down materially over the last 6 months. I mean, over the last month, I don't think things have changed very much. But definitely the prospects of a soft landing are the best they've been in the last year or two.
Something changed in the last 2 weeks for Chairman Powell. That's for sure. Bill, good to catch up. Bill Dudley there of Bloomberg Opinion, former New York Fed president.